Most active fund managers fail to beat the index. That is the most counterintuitive open secret in finance. The data is clear: over 15 years, nearly 90% underperform. This means that if you invest in an actively managed fund, the odds are heavily stacked against you. SPIVA, the S&P Indices versus Active Funds report, is the industry scoreboard. It compares actively managed funds to their benchmarks. The latest data paints a stark picture. Over 1 year, nearly 79% of U.S. active stock funds lag their benchmark. Over 5 years, that number jumps to almost 89%. Over 10 years, it's about 86%. And over 15 years, a staggering 90% fail to beat the index. This consistent pattern across various time horizons suggests that the longer you hold an active fund, the more likely it is to underperform. The reason is that over time, the compounding effect of higher fees and the difficulty of consistently picking winning stocks take their toll. This is not a short-term anomaly but a long-term trend. This bar chart shows the percentage of active funds that underperform their benchmark over different time horizons. Notice the pattern: the longer the period, the higher the failure rate. After 15 years, nearly 90% of active managers have been beaten by simply holding the index. This is a powerful visual representation of the challenges active managers face. The underlying mechanism is that while in the short term, some managers may get lucky with a few stock picks, over the long term, the odds of consistently outperforming diminish. This is because markets are efficient, and any edge a manager might have is quickly eroded by competition and costs. The chart underscores the difficulty of beating the market over extended periods. A landmark study in the Journal of Finance examined 2,076 U.S. stock funds over 32 years. The conclusion? The number of managers who consistently beat the market is statistically indistinguishable from zero. In other words, the few who do outperform are likely just lucky, not skilled. This is a powerful result because it controls for survivorship bias and other statistical traps. Survivorship bias occurs when failed funds are excluded from the analysis, making active managers look better than they actually are. By accounting for this, the study provides a more accurate picture. The implication is that even if you could identify a manager who has beaten the market in the past, there's no guarantee they will continue to do so in the future. This challenges the very premise of active fund management. How do researchers distinguish skill from luck? They use a simple framework. The null hypothesis is that no manager has true skill, so any outperformance is random. The test statistic compares the observed number of consistent winners to what chance alone would produce. If the observed number is not significantly higher than chance, we cannot reject the null. In the 32-year study, the number of managers who consistently beat the market was not significantly different from what would be expected by pure luck. This means that even though some managers do outperform, their success can be attributed to random chance rather than skill. This is a crucial distinction because it implies that past performance is not a reliable indicator of future results. Investors should be wary of chasing after star managers, as their success may be fleeting. In 2026, academic research suggested that SPIVA's methodology may systematically underestimate active fund performance. After adjusting for certain biases, the 20-year underperformance rate drops to about 55%. That's a significant revision, but even with this beautified data, active funds are only slightly better than a coin flip. And this still doesn't account for your probability of picking the winning fund in advance. The biases that were adjusted for might include survivorship bias, where failed funds are excluded, and the use of equal-weighted versus asset-weighted returns. While the adjusted numbers are more favorable to active managers, the odds are still not in your favor. Moreover, the challenge of identifying the few winners in advance remains daunting. This reinforces the idea that passive investing is a more reliable strategy for most investors. Let's compare the odds. With active funds, you face a 90% chance of underperforming over 15 years, and even in the best-case adjusted scenario, it's roughly a coin flip. With passive index funds, you are guaranteed the market return, minus minimal fees. The evidence strongly favors passive investing for most investors. The reason is that passive funds simply track an index, so they don't incur the high costs of active management, such as research and frequent trading. Over time, these cost savings compound, leading to higher net returns. Additionally, passive investing eliminates the risk of picking a fund manager who underperforms. While you won't beat the market, you also won't lag it significantly. For the majority of investors, this trade-off is well worth it. Fees are the silent killer. The formula is simple: your net return equals the gross return minus fees. Over decades, even a 1% fee difference compounds into a massive gap. For example, a $10,000 investment earning 8% gross over 30 years grows to over $100,000 with no fees, but with a 1% annual fee, it's only about $76,000. That's a 24% difference. This happens because the fee is deducted from your returns each year, reducing the base on which future returns are calculated. The impact is magnified over time due to compounding. This is why low-cost index funds are so powerful. They keep fees minimal, allowing more of your investment to grow. Even a small fee difference can have a significant impact on your final wealth, so it's crucial to pay attention to expense ratios. This line chart illustrates the impact of a 1% annual fee over 30 years. The blue line shows growth without fees, the orange line shows growth with a 1% fee. The gap widens over time, resulting in a final difference of over $24,000. This is why low-cost index funds are so powerful. The mechanism is compounding. The fee reduces the amount of money that is reinvested each year, so the growth rate is effectively lower. Over 30 years, this small annual drag accumulates into a substantial sum. The chart visually demonstrates that even a seemingly small fee can have a huge impact on long-term wealth. This is a key reason why many financial advisors recommend low-cost index funds over actively managed funds, which often have higher fees. Why do so many professionals fail? First, markets are highly efficient, prices already reflect available information. This means that it's very difficult to find undervalued stocks that the market hasn't already priced in. Second, active managers face higher costs from trading and research. These costs eat into returns, making it harder to beat the index. Third, behavioral biases like overconfidence lead to excessive trading, which can hurt performance. Finally, the benchmark itself is a tough competitor. It holds all stocks, not just the ones a manager likes. This means that the index benefits from the overall market's growth, while active managers may miss out on gains from stocks they don't hold. These factors combine to make it extremely challenging for active managers to consistently outperform. This table summarizes the key SPIVA numbers. The pattern is consistent: the longer the time horizon, the higher the underperformance rate. For example, over 1 year, 79% of active funds underperform, but over 15 years, that number rises to 90%. This is a powerful argument for passive investing. The reason for this trend is that over longer periods, the impact of fees and the difficulty of consistently making good stock picks become more pronounced. Short-term outperformance can be due to luck, but sustaining it over many years requires skill, which is rare. The table clearly shows that the odds of beating the market diminish with time, making it increasingly likely that you'll end up with lower returns than the index. These are the odds you face as an investor. Over 15 years, you have a 90% chance of underperforming with an active fund. Even with the 2026 adjustment, it's still about 55%. And the fee drag can cost you over 20% of your final wealth. The evidence is clear. This means that if you choose an active fund, you are likely to end up with less money than if you had simply invested in a low-cost index fund. The fee drag is particularly insidious because it's a guaranteed cost that reduces your returns regardless of the fund's performance. When you combine the high probability of underperformance with the certainty of fees, the case for passive investing becomes overwhelming. For most investors, the rational choice is to accept the market return and keep costs low. The evidence is overwhelming. Most active managers fail to beat the index, and the few who succeed are likely just lucky. Even with the 2026 critique, the odds are barely better than a coin toss. For most investors, low-cost index funds offer a guaranteed market return with minimal fees. That's not a surrender, it's a rational choice. By choosing passive investing, you avoid the risk of picking a losing fund and the drag of high fees. You also benefit from the long-term growth of the market, which has historically trended upward. While you won't beat the market, you also won't lag it significantly. This approach is based on evidence and is suitable for most investors, especially those with a long time horizon. We'll continue to bring you evidence-based insights into the world of finance. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.